Hi, it's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to keep it very simple. We're going to be talking about the S&P 500 only. So this is being recorded on Tuesday, so a day before the FOMC rate decision is released. And so it's going to have, of course, a big effect on all the major indices, but the S&P 500 especially, as we know, it being market cap weighted, the biggest names are going to really move it like it always does. So we'll talk about the setup and also what things could look like after the decision. So number one, we know it's been smooth sailing for many months now. And one way to look at that is just by tracking the number of 1% moves both up and down on a rolling monthly basis. And we've shown this table many times. It is extremely helpful because, as we know, if the volatility, if measured by the number of 1% gains and losses, remains low, what does that tell us? It tells us that breakouts are going to work. There will be fewer whipsaws, so breakouts will be cleaner. And when that happens, there's a higher probability of bullish pattern targets being hit. And that, in essence, is how uptrends are formed. And so, as we know, things really changed after the April low, and really, we like to talk about it changing on April 21st, because that was a key higher low. And from that point, that's when the character changed from extreme volatility on both sides, on the way down, of course, and then the explosive buying on the way up, to more consistent uptrend. And again, we don't even have to look at any charts to see what's going on here. Just by understanding that there's been no more than 1% gains or losses per month tells us exactly what we want to know. And this was extremely evident again in July, when for the first time since December 2019, we had 1% gains or losses for the entire month. Remember, coming into that, there was a lot of people expecting volatility to become fierce. And with the first earnings period happening, then, of course, it did not happen. And then we come to September. It was the most talked about month in terms of volatility returning. September and October are known to have a lot more volatility or two-way action over the course of many years from a seasonality standpoint. It is yet to occur as well. Most recently, we've been told many times over that the second half of September is when it gets really bad. We're entering that right now, and of course, with the Fed about to release rates, that could really happen. So understanding what the trends are and also witnessing what actually happens will tell us, of course, a lot more. And so again, so far this month, 1% gains or losses, a little bit more than halfway through. And if that were to happen again for the month, it would be surprising to many, many people. And it would be the second time it occurred during 2025. So we'll keep an eye on it. Again, we don't need to have a 0 number at the end of the month, but having these stay relatively low will give us an indication of how consistent and how strong the uptrend is. So the question, of course, is it too smooth at this point? So one way to look at this is by just understanding that we're up about 37% now in a little more than 5 months, right? This was the low, intraday low, April 7th. This most recent high intraday just today. So 37% up at some point. We know it's not a matter of if, it's a matter of when. So we can go back to 2023, 2024. This is a period we've compared this trading environment to numerous times. And along the way, as things are starting around here, we were always talking about what if the same type of scenario occurs where you have the really big amount of buying, this breadth thrust happening, and then moving into, again, a much calmer, more consistent uptrend. And we look back to here of what could occur, because the S&P never pulled back and say about 3% all the way until late March. And right now, having pulled back more than 3.5%. So it's even longer at this point. And as we can tell, 37% up versus 28 or almost 30% at the time. So we're much more in terms of percent gain at that point. And also now we can have longer before getting a major pullback that we got here. Now, as you recall, when that did occur, there were a lot of alarms going off, thinking that this is about to roll over, the party's over, so forth and so on. We've heard it before, we've heard it again now. And so what that resulted in, as we know now, was about a 6% decline, which felt a lot more fierce than it sounds, because, again, it was basically triple or double the amount of anything we saw up to that point. So what happened after that? We got the higher low in May. That formed a bullish pattern here, and off we went all the way to the end of July. So as we know, the second half of this run from October 2023 to the end of the year 2024 went through some phases. So after that first pullback of more than 6%, volatility did pick up, but along the way still making higher highs and higher lows. So that's one potential analog to keep in the back of our minds. Now there's another one as well that we and many others, of course, have been talking about, is 2020, because in terms of the acute turn and sharp moves of both periods, it was much more like 2020. One of the things we were looking at in 2020 was when we came back from that extreme oversold condition, how long it took for the S&P to get finally back to overbought territory on a weekly basis here, right? And as we can tell, didn't really get there until late first quarter of 2021, or really around April, right around that time. So that took a 90% gain from the low to get it there. And most recently, we're getting very close after only a 37% gain, only. But compared to what had to occur in 2020, how much longer it took and how much more of a gain, it's not even close to that just yet. Now, along the way, even though things turned into a consistent uptrend in 2021, it took a while for that to occur. Remember, the amount of 1% moves on a yearly basis was just insane, just about 130 for the year, and it didn't really slow down from that pace until the second quarter of 2021 began. So remember, we're calling June, the S&P was down about 9% in 2020, and then in September and October, down 10% twice, right? And so it was much more volatile along the way, and that's one of the reasons why it kept this off of overbought territory. Now we're just about there. So why we haven't seen a correction yet is because it's been much more consistent than it was in 2020, like we just talked about. So another way to look at this is just understanding that we've got now 30 trading days through Monday, September 15th, without a 1% decline. That is the longest such streak since 32, right before that. So the last 1% decline was on August 1st. Now it's interesting because, as we can tell here, that came 2 days after the Fed's last meeting. Remember, it was only a very small move overall on the Fed day, but then we followed it with a really big negative reversal on that Thursday, and then Friday, August 1st, was the big down day. As we can tell, the biggest one one of the biggest ones over the last few months, down 1.6%. Then we go back to the last time we had a 1% decline. Before that, again, there's only been two all the way since June here, and that was June 13th, which happened 3 trading days before the next Fed meeting. So even though the volatility has been obviously non-existent, there have been periods when we've seen a little bit more of a bigger pullback. Again, nothing more than 3.5%, but the last 2 times this happened, or 2 of the biggest ones, happened right around the Fed day, and not by coincidence, happening again as the S&P is again near its highs once more. And so would it be surprising to see more volatility come after the market is up so much, hitting overbought territory, both on a daily, weekly, and short-term basis, which we'll look at in a second? No, not at all. It's a matter of what happens after that. It's going to tell us a lot about this market's character. And so it's been more or less an ebb and flow over staircase-like advance since that point. So here is, we just mentioned, on a 2-hour basis, 2-hour chart, 14-period RSI, and along the way, there's been just a lot of small gains and small losses over the course of a number of days to weeks, which resulted in an uptrend. Most recently, had a gain just from the low from early September to most recent high of about 4%. Nothing crazy, but enough to then pull this RSI, again, 14-period RSI on a 2-hour chart, from oversold to overbought again. As we can tell, when that's happened, most recently, it just led to short-term top, which then led to these small losses. Again, not big at all, but because the trading range has been so narrow, it's been enough to produce oversold readings as well. So until this changes, we should expect the same thing to continue, where you get short-term overbought, decent profit taking, the profit taking happens, buyers get that dip that they're expecting, they start buying, and what happens? It goes back to new highs. So once more, when that changes, when the next pullback is bought, but that it fails to produce new highs, that could maybe force buyers' hands a little bit, or at least cause them to grow a little bit impatient. And when traders are impatient, what happens? emotions take over and they could start selling into, and that's how a key lower high could develop. And of course, lower highs are necessary components to topping patterns, which, as we know, have not played out. And we'll look at that at the end as well. And so along the way, as markets come back, we just looked at it from a short-term basis and a weekly basis. So on a daily perspective, just tagged at the 70 level or came very close to doing so just yesterday. Again, as we can tell, closed right at 69.70. So we're going to round that up to 70. And so these are all the other times in 2025 that the S&P has been overbought. And as we can tell, they happened after the market is rallying. But anytime we hear the word overbought, obviously is a negative connotation, especially with a market that continues to rally. But overall, it's really only been overbought for a handful of days in total. So it's not like every time the market goes up that we get an overbought reading with it. But bias is everything, because when that happens, when there's market making new highs, but the RSI does not, what does that produce? A negative momentum divergence. So if someone is bearish on the market, no matter what the RSI says, there's an easy interpretation that the market should be going lower, where it's too overbought, right? Overbought's bad, so to speak, so it can't continue, or it should be overbought when the market is going higher, but it's not, so it's showing us a negative divergence. And we should never ignore it, because when that happened from December through February, it obviously was a very good indication of the ensuing intense sell-off. Now, we know that was induced by all of the tariff talk and implementation. Regardless, we saw some changes underneath the surface as well. So we shouldn't ignore this, but it's always more so an indication or a condition of what the market is doing. As the S&P continues to make new highs, it doesn't do it every single day. And the back and forth movement, or the ebb and flow, as we talked about, within an uptrend, is going to, pull that RSI down from overbought. Most importantly, have it hold near 50, which it has been, and then go back and continue to do that. And if that is the case, that's the most important thing that confirms that the uptrend is still intact. So we're going to talk about patterns next, but before that, remind you that we have a free Substack newsletter called Cap Notes. You can go to capnotes.substack.com and you'll see a lot of this commentary and much more details. We put videos on there as well from our YouTube channel, also from the videos that we produce here for Stockcharts. You get access to premium pieces, which includes chart trades, which are obviously trade ideas based on charts. Again, that's capnotes.substack.com. Check it out, and I'll see you there. Okay, so let's talk about patterns, the crux of our analysis always. And so recently, a big target has been hit, and that was a 65.55 breakout objective that was triggered here on May 12th. We've been talking about this for a long time for various reasons. Number one, that was one of our highest targets to this point. And when it happened, there was a lot of pushback along the way, even though it never really got tested, right? This is kind of the risk zone that we highlight here. And yes, this gap got tested just a bit at the end of May, but obviously not a lot. And even on that particular trading session, the S&P was able to close in the upper half of its trading range. And so the pushback came from various reasons, and we can understand why. Number one, the S&P was already up 18% from the low in about 4 weeks. Now, it's taken 4 months to get there. And that's not surprising either, because a lot of times big patterns get developed from, again, intense volatility, but then when that volatility lessens, it just takes a while for that to occur. We talked about in the past that was very similar to the breakout that we got in January 2024 from 4,800. It produced a target of 6,100, so a lot higher, that did not get hit until December of last year. Most important part about that was that it extended from that breakout zone like this one did, and then formed smaller patterns along the way, which this has as well, finally getting to the target. So again, up 18% from the low in a very short amount of time. So anticipating that there will be another 15% gain after that was difficult for people to comprehend, because that would mean that we're way above the former highs after not being too far removed from the low here. And there wasn't really any conclusions from a tariff standpoint either. Going back to the technicals, we're getting very close to this 5,800 area. We know that the S&P just failed there in March. And also, it was a key spot at the beginning of the year as well. So a former support becomes resistance. We know that. And even if the S&P was able to get through that point after this gap higher on May 12th, then it had this entire range to eventually get through, which was capped again by 6,100, which the index failed at 5 different times from November to December to January to February. So even if we got through all that, getting right through 6,100 without any real congestion wasn't a believable scenario. As we know, that did happen, right? This 6,100 went right through it, and really that didn't even come into play at all, either going through it or not even being touched on the way down. Now, that's important because it was actually the third of the major bullish pattern targets we had in place. Right before that, the biggest one from a daily perspective up to that point was this cup and handle pattern that we saw a breakout from in late April, and it was hit 61.25 in June. And even before that, which really got us encouraged about this market making a comeback effort, was on an intraday basis using the 60-minute chart, was seeing finally some of this volatility give way to an identifiable inverse head and shoulders pattern. Got tested here, as we can tell, finally got hit right at 58.40 the same day, May 12th, that the last pattern that just got its target acquired got hit. In terms of live patterns now, we have 2 in place. One that was triggered on the same day with a target of 67.45 continues to be our highest price objective, which is now less than 2% away. And then one that just got triggered as the last one got acquired, which typically is something that you want to see over and over again. One, a bigger target then feeds into smaller ones being shaped and then obviously fired in terms of getting that breakout and eventually having the upside target hit. And so as of right now, within 1% of acquiring that, and this is what that looks like, right? 66, 65, again, very small pattern. Now, over the last few weeks, this is important because 2 smaller versions did not play out. So when that tends to happen, even the short-term patterns, it gets our attention because one of the first things you recall seeing in December, January, early February were small bullish patterns starting not to work. So seeing this one now hit its target potentially after 2 failed, it gives us an indication that these are continuing to be successful. In 67.45, again, same day it happened, looks a little different here, but same thing. Over the next ensuing few weeks, was tested, held, and off we went, right? And for higher targets like this to get acquired, we just need those smaller versions to occur. So if and when this does get hit, we're going to be looking for other formations then to take shape. Now, also key, of course, to uptrends are failed bearish patterns. We were eyeing this one for a while and took different iterations along the way. And with the S&P continuing to kind of fail near 6,500 up to recently and through August, we were keeping it on our daily reports. Finally, of course, it was negated. Wouldn't even call it negated because it didn't have a chance to fully get completed, which would have resulted in a pullback all the way back down to 6,200 and then seeing a break below that. Again, this is not anything different than what we've seen before. This is one we looked at. Again, this was the July 31st negative reversal into the August 1st 1% decline. And it looked like that ensuing rally that we saw at the beginning of August from the bounce was going to fail, and this would be a major top. Of course, it did not happen. And so we also saw iterations of this in June and again in May, and we continue to track these even though they're not working because eventually one will. And when bearish patterns fail, it gives way to very interested buyers, which then set the stage for bullish patterns to form. Another version that we're looking at is the series of rising bearish wedge patterns. Now, again, talked about this in the past. Don't really like the term bearish rising wedge patterns because these are just indications of the market moving higher. These are uptrends. We can combine the highs along the way to form what are called bearish wedge patterns. But regardless, what you need to see happen is not really a downside break. At some point, that's going to happen all the time. Uptrend lines are just made to be broken because eventually the pace changes. So when that pace changes, then results in something more substantial, you'll see it in the form of bearish patterns being formed, which one of these then ending up being a lower high. Hasn't happened yet. we'll continue to look at this because one time it will, and then we will see it in the form of the next rollover, either not being bought at all or being bought and producing a weak bouncing out. So in terms of the go, no-go charts, as you can imagine, this continues to be in bullish mode, which happened just 2 days before that May 12th breakout. So it all coincided with those bullish patterns being triggered. And so with these green dots and red arrows, it really just shows an oscillation of the index and the indicator here going between overbought and the neutral zone. So very similar to the RSI oscillating between 50 and 70, or even, the overbought conditions. And when that changes, of course, we'll see it. But so far, it is just really ping-ponging in between this trading channel, as indicated by the green dots, which shows buying within the uptrend, and the red arrows, which indicates sell-offs or a counter-trend move within index, for instance, that's still in an uptrend itself. And we saw the same type of action going back to the same period we've been talking about, late 2023 to 2024. And this was the time when that last red arrow actually did indicate a sell-off that was bigger than what we've seen. So we're always looking to see if that's going to be the case. And if we do see a market that's a little bit weak, or very weak for that matter, after the FOMC meeting, then another red counter trend arrow will appear. On a weekly standpoint, this is now week 13 of being in a bullish trend. So getting the go signal here. And if you go back, and we've talked about this before, but very important to understand how this has worked in the past. We've seen trends flip to bullish after long periods, the great financial crisis, and the initial number of months even of rallying. So you were thought that this was late, but as we know, it led to many months and years of uptrending action after that. Saw it here in 2012, once more in 2016. We can see how long this lasted, go to 2019, and then 2020 again. So if this is going to be like all those other periods, then it could tell us that we have much more to go in terms of this bullish trend remaining with us. On a monthly basis, we've been in a bullish trend mode, at least not bearish, ever since 2010 as well. So a lot has to happen for that to roll over. But as we can tell, when it did happen here in 2007, 2008, it really was able to nail the top with the rollover happening afterward. Now, again, it took a while to get back to bullish, but it was worth the wait. As sometimes we talk about, is it the lowest price that you want or the best price? Meaning the lowest price is always trying to call the bottom, trying to catch a falling knife. So in bear markets, you don't want to do that. You want to wait for indications of stability coming back. And that's why we showed those smaller bullish formations, right? That first 5840 target being hit. That was, in our perspective, the best case scenario because it finally saw a higher low being leveraged. That told us that the character had changed, not the crazy reversals that we saw in the beginning of April. And then lastly, I thought it'd be interesting to see how this looked on a yearly perspective using yearly bars, right? And so this goes back 100 years. And again, I don't know what's underneath the surface of these indicators, but this didn't flip all the way to bullish until 1960. So you may have missed a few 100 or 1,000% off the low here. So that's something to keep in mind. But from that point, nothing from then was bad enough to flip this yearly or annual trend to bearish, right? A few times we have amber here along the way, but we're talking about 1987, the great financial crisis. This whole thing was COVID, right? Massive reversal back higher. And so probably don't want to show this to short-term traders, of course, but if you're someone who focuses on the very long term, understand that the S&P 500 has been in a long-term uptrend for many, many years. So that's the setup heading into the FOMC meeting. Regardless of what happens, you want to see how eager buyers are, number one, to step up to any dip that happens, and just as important, what comes after that. Because again, we're looking for not just dip buying, we're looking for that next phase to create the next higher low, which could then produce the next set of bullish patterns. Thanks. I'll talk to you next time.